Welcome to Investor Copilot. I am Viraj, and today we are going to discuss portfolio compositions for your invested capital. So let's get started. Now, before we look at portfolios, let's look at why should we invest or trade at all. So the long-term goal of investment or trading is definitely wealth creation for yourself and your family. The wealth creation can also be directed towards a higher purpose or financial goal that you want to achieve in your life. Anything that you want to do with your wealth, a significant amount of funds, that is your long term goal. And typically, it is 30 or 40 years horizon where you're trying to grow these funds. However, short term goal of trading is to create disposable or spare income. And short term would imply anywhere between 6 months or 3 years. This is the time period where you can make moves into the market and try to grow your funds. So there is long-term goal and short-term goals. Both goals are valid and dependent upon individual preferences. So the comfort level of what you want to do with your funds, how you want to move in the market, and what kind of tactics and strategies you want to use to invest your funds is a personal preference. If you want to become a very active investor, then short term goals and short term trading is advisable for you. If you want to park your funds and wait for them to grow over a long period of time, then long term goals and chasing them is suitable for you. This channel aims to teach both. Now, trading or investing in the markets lets you utilize your understanding and awareness to make profits. Well researched and planned short term trading can reap benefits. So that is these 2 points are just to highlight the focus of this channel as well. This is what we're trying to impart here and achieve for our viewers. A word of caution now. So I want to talk about speculative trading, intraday trading, or futures and options trading. These are advanced forms of trading and require a deep understanding of the markets, expertise in reading and predicting stock price movement, and high financial risk tolerance. This channel is not focused on such type of trading, but I in no way discourage anyone from trading into speculative options or futures or intraday because I think that these are valid forms of trading as well, but require a lot of expertise. And this channel is not really geared towards teaching you to manage and mitigate and take these kind of risks. Okay. Now, let's look at portfolio compositions. So, first of all, we look at high GR portfolio. GR stands for gain and risk. So, high gain, high risk portfolio. The target age groups, I believe, for these portfolios are between 25 to 45. And the capital typically available to invest with you is low and limited in these age groups, which is generally the case for many people, not everyone. So, high GR portfolio is targeted towards growing your capital at a rapid pace, and that is something that you should be doing between these age groups through a high gain, high risk portfolio. Second one is a medium GR portfolio, which is suitable for age groups 45 to 60. Here, your life is a little more stable, and career wise or family wise, you've reached a point where you know where you're going, and the certain amount of predictability enters the life post 45. So, even the capital available here is low to medium. And if you have been following a high GR portfolio, you do have a sizable capital to invest and grow post 45. So 45 to 60, I would say medium GR portfolio is good to go with. Low GR portfolio is definitely suitable for age group 60 and above. Capital available here is expected to be medium to high and stable in its sense because your expenses become predictable here. Maybe you know your income is also predictable because many people go through retirement post 60. So there is no need to take unnecessary risks in the market, I believe, after the age of 60. So we do have a low GR portfolio that I'll talk about. Okay. Let's look at high GR portfolio composition. As you can see, 20% of this portfolio should be blue chip stocks. What is blue chip stocks? These are stocks which are uh, uh, believed to be very stable, have a good, these companies have a good dividend track record, a stable management, and these stocks are large cap, which means the companies that belong in this group have a large market cap, a good history of dividend declaration, a good history of stock growth. So your Apples, Microsoft, Amazon, Alphabet would definitely be blue chip. In Canada, the banks, Royal Bank, Scotia Bank, TD, even energy companies would definitely be under blue chip, some of them. Example would be Enbridge. In the US, there are many more examples. We will dissect and talk about blue chip stocks and their classification definitely more in this channel. 20% blue chip, next 20% in your portfolio should be growth stocks. Now you're trying to focus on growth as well. So growth stocks are the ones where these companies are mid cap, which means their market cap is not very high. However, they are targeting growth, and these are growing companies, so they have not matured in their revenue or business model, but they are growing very well, and they are into a product or service which is poised to for a tremendous amount of growth in future. Identifying these companies is hard. It's a tough task, and believe me, there are many fund managers and many people trying to get a sense of which are the real growth stocks, which are the Facebooks or the Amazons or the Apples of the future next 30 years. Many people are trying to do that, and this should definitely be 20% of your portfolio. Then 40% should be diversified ETFs, diversified in the sense that there should be sectoral ETFs and index ETFs. Both of them should be part of this particular sector of your composition. We'll talk about ETF diversification also in depth later on. And then lastly, 20% of the portfolio should be high yield bonds. And when I say high yield, I mean that you are not very much concerned about the credit rating here rather than the actual yield that is seen for the bond. So good yield should be your focus for this high GR portfolio. You can take a little bit of risks with bonds as well, definitely. Okay, let's look at the next one. So medium GR portfolio composition. Now in here, you should be bumping up the blue chip stock percentage to 30. Uh, we discussed blue chip stocks. We'll talk more about them definitely. Then 40% should be index ETFs. You should get rid of sectoral ETFs in a medium GR. Only index ETFs are advisable to be invested in. In terms of bonds, 30% of your portfolio should be bonds, and these should be have a good credit rating. So A, AA, AAA bonds, rating is important here. So good bonds, and then 10% should be GICs, which gives like an anchor and a stability to your entire portfolio. So this, in my opinion, should be a medium GI portfolio. Low GR portfolio composition, let's look at this. So 20% blue chip stocks, 30% index ETFs, 30% AA and AAA bonds, and 20% GICs. This is my low GR portfolio, and simply put, some people will question why is there a 50% allocation into stocks and ETFs in this portfolio? What is the need for doing this? This is because I believe that 50% of allocation in stocks and equities gives you that ready liquidity, and at a very low risk, to be honest, but it's a ready liquidity because ideally, bonds and GICs are not very liquid assets, and you should not be uh, like breaking them or cash them out before maturity. It's not a good tactic, according to me, at all. So The 50% in stocks and index ETFs you can sell anytime. So this gives you liquidity. The remaining 50% gives you that stability that you need. So this, according to me, is a low GR portfolio. Now, before we part, I would say I want to have a word regarding the real estate investments as well. Those investments, some people believe in real estate a lot and they focus on real estate investments as their main vehicle for growth. If that real estate is part of your strategy to grow your funds, fair enough. The portfolios that I talk about, they are held in the brokerage. So these instruments, these securities are held in the brokerage account, and that's what I talk about. So if real estate is part of your plan, then absolutely go for it. It's also turned out to be a very safe and lucrative investment in Canada at least, and many people have successfully grown their capital and grown it long term through real estate as well. So apart from that, this is my take on portfolio compositions. We'll talk more about dissecting these and have a detailed breakdown of compositions later on in this channel. Thank you for watching.